Okay, so there's no need for a pity party. I mean, we can talk about it all day, how the market sucks. I mean, 4% down on the NASDAQ in a single day. Dow Jones is down another 2.5%. S&P 500 down another 2%. Everything is going down. Tech, growth, value. Mitt Kevin actually posting on Twitter that he lost $2 million and a couple of friends. Again, everybody's just freaking out. There's no need for a pity party. There's no need for emotions. There's just need for clean, objective analytics. Now, in this video, I need 3 minutes of your time to explain to you exactly what's going on and how to proceed next. Of course, this is not financial advice. I'm just going to share with you my own opinion about how things are shaking up and what I'm doing next. As always, my opinion might be inaccurate, might be wrong, might be the ramblings of a madman. You got to do your research, talk to a professional. But if you want to hear what I'm doing next, I'm going to shock you. I'm not selling anything. In fact, I'm actually buying. And I'll tell you what, stay with me. It's going to be a blast. Let's go. Okay, so in this video, I'll show you why I'm not only not selling, why I'm in fact buying, and it's not Palantir or Tesla. Those I always am buying in any market, but I'm adding one more stock to my small portfolio, which only has 4 stocks so far. And this stock I've never covered, I never talked about. And in this video, I'll show you why I think this specific stock is the best addition to my portfolio in this turbulent market. The macro stuff are pushing the entire market down because what's happening right now is a combination of a few things that the market is pricing in. The markets are really good at pricing in things before they happen. And as you heard over the past few weeks, everybody's talking about how the Fed is going to increase the pace in which it's going to increase interest rates. So before, the consensus was we're going to have 7 rate hikes in this year, meaning 1.75% interest, and every time 0.25, 0.25, 0.25 going forward. Now, in May 4th, we have another hike coming up, and based on everything we're hearing, Nomura, Jeremy Siegel, everybody's talking about 0.5 to 0.75. And if you think about it, that's literally 2 or 3 times more than what the market has already priced in. So that actually has to be priced in. Not to mention the fact that the 7 rate hikes that we talked about are no longer relevant. Right now, the consensus is shaping up around 3.5% instead of 1.75 by the end of this year. So that has to be priced in. Things in Russia and Ukraine aren't looking so hot. That has to be priced in. Further escalation, commodities, food shortages, copper prices. Basically, everything is going up. Inflation numbers, everything is just going to shit. And the market is starting to price in the possibility of a recession and a high inflation, potentially maybe even high unemployment, stagflation, God forbid. So all of these risks are now getting priced in before the May 4th announcement. Now, in this kind of red period, it's really easy to panic and just sell everything, say, I'm done with it. The market is just too crazy. Hold on a second. Hold on. There's actually opportunities in this market, and that's why I'm going to be actually putting a new position into my own personal portfolio. In my own personal portfolio, I only have the S&P 500, Google, Tesla, and Palantir. I'm going to be adding a new stock, which I have never had before, and I'm going to show you in a second. Check this out. On the screen right now, this is the stock I'm talking about. It's called FCX. This is from TipRanks. The stock is valued at $49.93 by 15 ratings, which is 24% upside. I'm not investing because of the TipRanks ranking. I just think it's very interesting to see what analysts are saying about the stock. There's a wide range of analysts that are talking about the stock. If you screen by 5-star analysts, some are selling that it's a sell, some selling it's a buy. There's a guy who gives it 37% upside. There's somebody who gives it 28% downside. So you can pick and choose whatever consensus you want to actually get on board with, but that doesn't matter. The aggregate result is that 15 analysts are seeing in aggregate a 24% upside for the stock, around $50. Now, if you actually take a look at the stock, it's a copper producer. It's everything opposite of the excitement of the growth and the tech plays, but I believe it's a huge opportunity. This is a $61 billion company. The short interest is very low, under 2%. It's a dividend company, and they're in a very hot category, as I'm about to show in a second. Over the past 6 months, the stock did about 3.4%. Over the past month, it's actually down 18.6%. And I believe that this cliff coming down from 50 all the way down to 40 is a huge opportunity. I'm going to show in a second why. Now, before we go into the numbers, the financials, the free cash flow, and all that stuff, I want to show you some assumptions which are really critical for why I'm going balls deep on this company. And this is the reason why I'm so excited about this company. I wanted to highlight some key points for you. And I did it in a simple word format, so it's easy to digest. Look at the screen. Electric vehicles, they need copper. We know that, right? Batteries, motors, wiring. We also know that charging infrastructure, not only supercharger networks, but basically even home chargers, electrical grids, they need copper as well. So, for example, internal combustion engines require 23 kilograms or 50 pounds per car of copper. That's standard. So even regular cars, they need copper, 23 kilograms or 50 pounds per car. Now, for EVs, that's 80 kilograms or 175 pounds per car, 4 times more. Now, Tesla on its own is going to make 3 million EVs within the next 2 years. Now, by 2030, based on the most conservative estimates, we have 25 million EVs globally riding around. Now, 25 million times 80 kilograms per vehicle, that's 2.2 million tons of copper. That's 10% of the current global annual supply. And mind you, the global annual supply of copper doesn't really grow. It is what it is. And if you listen to some professionals from the copper industry, they'll tell you that 25 million per year, that's it. They can't get out more than that. It's very, very difficult. Now, look, EV chargers also, you have to consider the fact that they also need copper. 1 kilogram copper per charger, including home chargers. And if you're talking about fast chargers, 8 kilograms. That's not even included in the 2.2 million tons. So I think it's safe to assume, based on these numbers alone, just on the EV industry, not talking about commodities, not talking about inflation, not talking about increased demand, reopening, none of this stuff. Just based on the EV industry, copper is going to be a hot commodity in the next few years. However, this company specifically is somehow still undervalued despite quite phenomenal numbers I'm going to show right now on the screen. And I want you to see the margins beyond the A plus here as what they are. And this is just based on current pricing of copper. And as prices will, by definition, go up, it's inevitable, these margins are going to go wider and wider. That's just how it is. And I want you to look at the valuation of this company, because the valuation is really interesting. Price to sales, 2.4. Forward price to sales, 2.15. So these are low multiples. This is pretty much as low as you can get. Now, a company of this sort, which will give you also a dividend, as you can see right here, a dividend company, $61 billion market cap, nobody shorting it. Look at the financials here, because this is really where it gets interesting. So as you can see, the revenues fluctuate. It's a copper company. The price of copper, basically, they live and die by the price of copper. So some years you'll see 18, some years you see 21, 20, then 14.6, then 14.8, then 16. So the price fluctuations are really important for this company. So if you're investing in this company, you're investing based on the assumption that prices of copper are going to go up because supply will remain the same, demand will go up. Simple 101 economics, which I believe to be true. Now, you're already starting to see this happening. Look, 14.2 in 2020, then 22.8 in 2021, 24.6 trailing 12 months. Now, this 14 might be COVID-induced, but they had 14 billion years before. But whatever you want to say about COVID and fluctuations and reopening, right now, the trailing 12 months, it's the best year they had in the past 10 years, 24.6. No year comes even close to that. Now, look, the more interesting part here is the efficiency, because they're price dominated. Look at this. Cost of revenues really doesn't change. So this year, where they made 14.2 billion, cost of revenues was 10.1. Then they went to 24.6. Cost of revenues went up by 25%? That's it. The same thing goes for SG&A. SG&A doesn't change. From the year where they had 14.4 billion to the year when they had 24.6 billion revenues, SG&A actually went down. So as you can see, it's all about the price action. The company will make the same amount of expenses, but if the price of copper gets pushed up, they'll make a lot of money without any increase in expenses, which is the cool part. And I want you to see their EBITDA right here. So they went from 2.2, 3.8, 10.5, 11.8, and same for dividend per share. As you can see right here, the dividend per share went from 20 cents all the way to 38 cents. And in the last 12 months, it went to 45 cents. So as the company is growing and their margins are growing because of increased demand and increased prices of copper, you participate not only in the share price, actually a nice little dividend, which is always nice to have, especially in recessionary times. And looking at their cash flow, I want you to look at what I just highlighted. $5 billion of net income per year. This is insane. Trading at 60 billion market cap. So 60 billion valuation for a company that gives you 5 billion net income. It's a really low valuation. Now, looking at the cash from operations, look, 8.3 billion per year. This is insane. Now, look at this stuff right here. I want you to look at net change in cash, 3.7 billion. So this is cash in the bank. Company is just generating cash up the wazoo. No need to get capital. No need to be sensitive to higher interest rates because they're printing money essentially. And looking at their balance sheet, you can see just the strength. They're sitting on a pile of cash, $8.3 billion in cash. Total assets are 48.8 billion. Let's see if they have any goodwill. No goodwill, so straight up 48, let's just say 49 billion in assets. Total liabilities are 24.8. So almost, not almost, actually 2x assets versus liabilities. So a strong balance sheet with a lot of cash. Do they have debt here? Let's see if they have total debt is 9.6 billion. So straight up cash for debt, they're almost at complete balance. So they can repay the debt right now if they wanted to. I mean, I guess they'll have to as the interest rates will go up. But this is one of the healthiest companies we've seen, which is that copper is going to be in high demand because of the EV industry and the amount of cars, the amount of infrastructure it's going to require also on the infrastructure side, not just the superchargers, also the home infrastructure, also the electrical grid. If everybody now has an EV or every third person has an EV, the electrical grids inside the cities will have to adjust. It's not going to be enough to sustain that without making massive improvements and investments in local infrastructure. That's going to require a lot of copper. As you just saw, electric vehicles need 4 times more copper than internal combustion vehicle. I mean, it just seems to me in a highly inflationary environment where there's massive demand for commodities and precious metals, and we have a booming EV industry, to assume that the price isn't going to go up, it's a very interesting bet, which I'm not going to take. I'm going to take the opposite side of the bet, especially for a company that dropped 20% of the past 5 days, from 50 to 40, a company that seems to be right on track to be an immune company towards all the insanity that's in the market right now. So instead of selling off my stuff and going crying in the corner, having a pity party, I'm going to be changing my strategy and adding plays that traditionally I don't have in my portfolio to protect myself and play a little bit more of a defense through copper prices. In fact, I think this might be the best way to get exposure to the electric vehicle industry without paying insane valuations. Like if you want to invest in electric vehicles and you're afraid to invest in Tesla, for example, because of its insane valuations, I don't know why would you. I mean, Tesla is a great investment, but this company will allow you exposure to EV industry at what price to sales of 2.4. I mean, for me, it's a no-brainer. But again, you got to do your research, talk to a professional, make sure you cross your T's and dot your I's or whatever. Make sure you know what you want to do before you actually invest. Don't just do it based on the YouTube video, but this is just to give you an idea to start your research. If you want more ideas like that, head on over to our Patreon. The link is going to be below. I'll see you there. And thank you for the existing Patreon members and channel members. Thank you so much. See you tomorrow.